We expect public sector banks to start consolidating and focus on capital conservation along with building efficiencies rather than just strive for growth. Given the lack of visibility on growth capital for public sector banks, the loan expansion could moderate to a compounded annual growth rate of 9% over FY16 to FY19. This is bare minimum to generate sufficient spreads that can absorb the expected operating and credit cost over this period. We believe the growth is likely to be lower for mid-sized public sector banks at a mere CAGR of 8% over the same period, which includes a loan book decline for some of the mid-sized banks. We estimate average Tier 1 capital needed over FY17 to FY19 at around 22% of FY16 CET for all public sector banks put together. The figure would be higher for mid-sized PSBs at around 36%. Our estimate is over and above the capital committed under the Indradhanush program. Apart from this, we also expect public sector banks, especially the large public sector banks, to monetize some of their non-core assets in FY17 to shore up capital. We estimate total non-core capital of around 195 billion, which would be at one-time price to book, much of it locked in businesses like insurance and AMCs, which can again be monetized over the next 2 to 3 years. Post the asset quality review, we estimate around 6 to 7% of total bank credit in the form of corporate exposure to be under stress and unrecognized in the bank books. Much of the remaining stressed exposure is from the infrastructure sector. We estimate slippages in FY17 to be lower than FY16, though the credit cost could remain at elevated levels. We believe around 1.5% of total bank credit which is stressed to slip in FY17. We believe credit costs to be at elevated levels in FY17. However, much of this impact is on account of NPL aging instead of fresh slippages. Under the asset quality review, many of these large borrower accounts have been recognized as non-performing from the date of restructuring, and we expect a sizable portion of NPLs, including some of the large slippages in FY15, to shift to next classification bucket over the next 12 to 18 months and hence attract a higher provisioning. Our estimate for credit costs in FY17 are around 170 to 180 bips. Despite the pressure on internal accruals from low growth and high credit cost, we estimate the potential bailout cost to avoid approaching the point of non-viability triggers to be manageable. Consequently, the support floor for long-term issuer rating on PSBs is likely to remain unchanged unless the articulation of government support changes. However, the AT1 ratings could be under pressure on account of deterioration in the standalone profile of banks, which affects their coupon payment ability.